Good morning, everybody, and welcome to the Daily Energy Markets podcast. We have Brent crude oil trading this morning, breaking out of its sort of low 80s range, now trading close to $87 a barrel, up a few cents after yesterday's surge. Now looking at 86.77 with WTI about $3 back. Let's kick off this morning in the United States, where we have the opportunity to speak with Brian Pieri in Colorado, the beautiful Colorado, founding member of Energy Rogue. Brian, has the U.S. Energy industry gone rogue in the sense that it's not pumping very much oil or adding very much oil this year? Does that continue to be the outlook? First half's, probably surprise story of the year was how little oil the U.S. added, kept prices elevated, are part of the reason why. What's the outlook for the second half?
I think the outlook for the second half, I'm more on the bearish side of the equation when it comes to not prices, but production. So I expect production to start to taper off and declines are going to start catching up because we've been reducing rigs in the United States since early 2023. So if you look at the production surge in 2023, a lot of that was left over from drilling activity that was happening in 2022. There's a delayed impact to bring that production online. So with the continued drop of rigs, we have had some rig efficiencies that have added some, so you can reduce the number of rigs and still have higher output. But when we look at the number of rigs that have dropped, I think we're going to exit the year below 13 million barrels a day, probably 12.5. It would probably be my number. So that's a little contrarian, a little rogue. So that's my expectation on crude oil production. We're essentially at the same level that we were back in October. We haven't moved up or down. We've been pretty much flatlined since October.
Right. I lost your sound there. I don't know if that was my connection or yours, but Russell Robertson, Chief Commercial Officer at Dubai Mercantile Exchange, in one of the main pricing platforms for East of Suez crude oil. We've heard the supply side there from Brian, a little bit constrained with U.S. production flat this year. Obviously, OPEC supply constraints continuing with nearly 5 or 6 million barrels off the production shut in. What about the demand side in Asia, Russell? Your bridge between Dubai and Singapore. Is Asia offering that demand factor? Is that the reason why we're seeing Brent crude oil break out of the current low 80s range?
Good morning, Sean. Hello from Singapore. So there's a few different things there. Chinese refineries tend to be running on a lower refining cycle than they have been previously. So that doesn't quite fit to the higher prices. However, it does seem to be more of a supply issue than demand, I think. So as we saw prices come off quite hard after the OPEC announcements, they've rallied quite successfully. As you say, we're in the $86 handle mark today. But we've also seen some of the spreads move quite a lot. So Brent was trading at a discount to Middle East for quite most part of the second half of last year. Last month, we saw that move into positive. So Brent was trading a good $60, $70 above Middle East for a few days. As we've rolled into this month, that has gone back to parity. That seemed to be much more related to Brent rather than any other market. So Brent was being quite there was a few players in the market were buying up a lot of the Brent cargoes in the window, which was causing the Brent market to create premium against Middle East. We didn't see that happen for TI or for other sort of sweet sour contracts. So it seems to be much more of a supply issue rather than anything on the demand side. On the demand side, you also see some of the Chinese refineries, they like the sour basket. Some of that sour basket from the Middle East is reduced. particularly Upper Zakum, for example, was reduced as Ruwais is taking more Murban barrels. So that's causing a bit of tightness on that side, and probably why you see Brent pricing slightly differently to Murban at the moment.
Mehmet Oguchu, Group CEO, Global Resources Partnership Chairman, and Chairman of the London Energy Club. Mehmet, we've heard from Brian there that the supply side from the US is constrained, OPEC plus supply constrained, but yet demand not so strong in Asia. So is it geopolitics that is giving oil the opportunity to break higher out of this essentially low 80 sweet spot for the first half of the year, where the average price of Brent was $84? We're now knocking on the door of 87. And the last time we ascended up towards 90 was in that sort of critical geopolitical moment in the first half when Iran and Israel faced off for a possible direct conflict. We have that happening again in Lebanon with Hezbollah and Israel looking, sort of banging heads more ferociously than usual. Your thoughts on geopolitical risk premium now returning to the market?
I think this is returning back, as we have been discussing for a long time, and the geopolitics is back, but in different ways it is affecting the prices. The markets bought already geopolitical risks. However, now the critical developments evolving in Israel, Gaza, and now Hezbollah, and Iran also somehow getting into the target, because there are expectations that sooner or later there will be some sort of targeting of Iran, not only economically, but also conflictual wise. But there are new alliances being formed as well. We discussed already that how Turkey was engaged somehow with the Gulf countries and Egypt. Now a new step has been taken with the mediation of Iraq. There will be a meeting of Turkey and Syrian leaders taking place in Iraq in order to normalize the relationship. Russia is pushing for that. China is pushing for that. Iran is very happy that this is happening. So there is a new regional configuration happening in the region. And then we see what's happening in the Black Sea, Ukraine, Russia war, drone attacks. But still, it's dragging on. So it's a prolonged war, not much happening. And then there is still worry about Russian intentions towards Eastern and Central European countries and Southeast Europe as well. Then what will happen in Libya, in other parts of Africa? So the tension is building up. Nobody is expecting that we are going to have a smooth running of the markets. Geopolitics will always be there. Conflicts will flare up and go down, and then the markets will respond to that. But as you said, I think the price increases to $87 right now is so much related to the new flare-up in geopolitical tensions.
And Mehmet, if I might just follow up on that. I mean, we have the geopolitical tensions on the ground, literally the actions on the ground in the border between Israel and Lebanon, the actions, obviously the ongoing slaughter in Gaza. But we also have on the sort of other side of that coin is a very weak U.S. president. In the U.S. election cycle, typically you would have the president distracted because he's trying to get reelected. But now it looks like we have a doubly weakened U.S. president, where there's even question marks whether he has his compos mentis in a very serious, very sort of concerning display at the debate last week. What factor do you think the extra weakened American president has on the sort of burning fires, geopolitical fires?
Well, I mean, I think he showed a very bad performance, as we all agree, during the televised debate with Trump. And he's a lame duck in any case. And as you say, there is going to be a huge effort for him and his supporters to put into the elections. Then I think we will have a weakened administration in many ways, a weakened president and weakened administration at the same time. So this is an opportune time for any other global or regional power to do whatever they want, in a way. U.S. intervention, U.S. pushing forward will not be so credible in that regard. So wait, China or Russia or Iran to take some steps. I mean, as we know, Israel is not listening to Biden, despite all the pressure about Gaza. So they have done whatever they wanted. Therefore, we have a weak president whose words are not listened. And this is what also Trump is saying. So then also the expectation that Trump will come to power from January 2025 changes the picture altogether as well, including for the energy markets. Whether Trump is going to somehow destabilize the world energy markets, because I don't think he's going to stick to the decarbonization goal to 2050. He's going to probably dismantle the 2035 target for the power industry. He will have softer targets and goals for EPA, and he will push probably fossil fuels further. So the peak oil will be pushed out for a long time to come. Therefore, the current vacancy in presidency and the future policies of the new president, likely to be Trump, if there is not going to be anything very dramatic happening, will change the energy markets significantly. So we have to be prepared for that. But now there is a certain period of
Brian,
instability and risks.
There is. I mean, always at this time and into the deep U.S. election cycle, it just feels doubly this occasion that this will be controversial in the geopolitical arena. But still, the good old-fashioned drive. What a factor, how does that look for this season and for being one of the factors driving prices higher out of their low 80s range?
Okay, part of that cut out on my side. I'm not sure if everybody else heard that, but could you repeat that question?
I was saying how is the outlook for the summer driving season impacting the current sort of push higher in oil prices, that actually this is good old-fashioned demand as people get in their cars to go on holidays?
Yeah, one thing, if we trace back in time to last fall, OPEC had one of the strongest predictions for oil demand for 2024. And what happened is that other agencies such as IEA, EIA, other pick 'em, were very tepid on what the oil demand was going to be, but they've slowly come up to where OPEC first put the mark. So they haven't reached the same level, but one of the interesting things is all of the models for every one of them showed second half being when oil was really going to pick up. So I think we're in the second half of the year is really going to be the show me side. Prices will respond to how demand is. If demand is relatively tepid or sluggish, we are going to have some price corrections. I would actually agree with Omar. I listened on Monday, and I'm definitely aligned that we are in a structural move up, and that move is going to happen over the next 5 to 10 years probably. But my opinion on the summer driving season is the early numbers are looking good and strong, but one thing that's very interesting that has me a little cautious when it comes to demand, when it comes to oil prices, is diesel has been a little weak lately, especially in the United States. And that can be a leading indicator of some of the big economy, because diesel runs a lot of construction, a lot of transport fuel. So that could be a leading indicator that we have some softness to come. And we're already getting indications out of that from China. India is still thumping along, but China is showing a little sluggishness as well. So as much as the consumer driving season is showing good numbers, that's the canary in the gold in the coal mine that I'm looking at that could be an indicator of some weakness coming ahead. I think there might be just a natural seasonal dip and then it might correct, but that's the number that I'm going to be watching over the next month.
Russell, just picking up on that, of course, we are expecting in the next few days, early in the month, the Saudi Arabia's official selling price, OSPs, into Asia. We saw last month, the first time in many months, that they actually declined this year after a number of months of increases. Your thoughts on expectations of that, given that China's factory slowdown data last few days has been fairly bearish. Your thoughts on what the Saudi and the other Gulf states typically follow OSPs might tell us.
Yeah, so just to follow up on what Brian said, we've seen very similar slowdowns in China. So refining runs last month or month before in May was the lowest of the year. There was some maintenance taking place, but there was a clear shortage or less output of diesel, particularly. So that equates to very much what Brian was saying. That seemed to continue through this month, but as we get into the next part of the year, there definitely seemed to be growth potential there as demand increases. However, OPEC is, we all know, talking about releasing some more barrels in the second half of the year. So you might just tend to see a bit more balance taking place. I don't personally expect to see any huge volatility in that particular supply and demand fundamental. When it comes to OSPs, there seems to be an expectation that there will be a reduction this month, with Saudi OSP probably being a little bit lower on the discount side. I don't have a particular reason why that might be. There's so many different fundamentals at play at the moment. The market being quite big.
Ultimately, if you want to sell your oil, it's got to be a bit cheaper, I suppose.
Yeah, so there's always. Yeah, some people forget that sometimes these guys are looking for market share, and that could be well part of it. Arab Light particularly has got a lot more demand in China at the moment. It's an available grade. Oman is always balanced, so on the tight side anyway. We've seen the Platts.
I suppose what would be interesting this time is that if given last month there was a sort of a weakness in the oil price and the oil markets, and so a lower OSP seemed to go in alignment with the general market. Now we've got a more bullish upward move. Yeah. Will that be reflected in an upward move in the OSPs? It feels like they may go in opposite directions this month.
Agreed. Yeah, 85 is a good number for the region. 85 has been a good number for the last almost 2 years now. I think 85.19 is the exact middle of all of this activity. So, yeah, I expect to see OSP slightly lower this month. A lot more to do with probably market share rather than anything to do with supply and demand fundamentals.
Mehmet, just coming back to the geopolitical risk. I mean, one of the, I don't know if it's a black swan yet, but I'm going to certainly put it in that category. The situation in France seemed to come out of nowhere, and now is the geopolitical fracture right down the middle of Europe, kind of makes the dysfunctional UK look nearly stable. Your thoughts on how the French election eventually plays out with the second leg next weekend, and then the obvious move to the right, the far right, who ends up in power? What does it mean for Europe, do you think?
Well, President Emmanuel Macron played with political fire, and he got burned, clearly.
We all got burned.
He got burned. And in the first round, the National Party, the extreme right party, got around 33% of the vote. And the left party, Left Alliance, around, I think, 22%. And his party trailed in the third place. And what will happen now? Of course, we have to wait until Sunday, the second round of the elections, unless the left-wingers, Macron supporters got together and have a new grand national coalition against Le Pen. I think Le Pen is likely to win the election, but I don't think that she will get the overall majority in the parliament. I think we have around 577 members of the parliament. And so there will be a deadlock, political deadlock. And Le Pen says that unless she's going to be the prime minister or his protege becomes the prime minister, and they are not going to be in the government, that means there will be a government crisis until next year when the presidential election is due. So he put himself in a cage, actually, Macron, The consequences will be that now in Europe, you have Orban in Hungary, and then you have also Meloni in Italy, in also Netherlands, Germany. Hardliners, extreme right-wingers are gaining upper hands. And so the union, I think, will be a weaker one. They are going to probably change the Schengen Agreement somehow so that the borders will be controlled nationally. Energy policies will be more nationalistic rather than EU-wide. And also EU's role will be questioned around the world. It's already, as we know, economic giant and political dwarf. I don't think it's going to change much while things are happening around EU, from Ukraine to Eastern Mediterranean and Caucasus, Turkey. So EU will be a sort of an irrelevant power. Therefore, we should see the elections in France, not only what's happening in France through Macron versus Le Pen, it's going to affect the whole position of Europe in the world. I think the trend is a worrisome one. Of course, nothing has been lost yet. We have to wait until Sunday, but I don't think that much will change.
In the most particular case, what it means for Ukraine and maybe for the outlook, the war there, that Zelensky and the Ukrainian defense might find themselves increasingly isolated, as they did during the period last year when they couldn't get the money from the US. And in that isolation and desperation, they take on more desperate measures like attacking the Russian oil infrastructure. I'm just sort of finding that intersection point of what this might mean for the markets as the sort of European heavyweights move away from Zelensky and Ukraine, that they may be forced to get a bit more dramatic. Let's go to the survey question today, which is sort of tackling this point of what is giving the biggest impact on pushing oil higher to break out of the low 80s band. The geopolitical risk returns, the hurricane supply threat we haven't really mentioned, but nonetheless is coming into the Gulf of Mexico, a summer travel demand, which Brian mentioned, or none of the above. Or all of the above. I wouldn't give that option on a survey question, but nonetheless, it's, one could argue it is all of the above. But which do you think is the biggest impact on pushing oil higher at the moment? And welcome your insights and thoughts on what that might be. Brian, I know you're not a political analyst, but you sit closer to Middle America than us, and most notably in Colorado, which of course is a swing state, or has become a kind of a blue sort of / swing state. How bad, how damaged is Biden now? On the ground, does it feel like some kind of line has been crossed here? Your thoughts a few days after the debate and the fallout and what that looks and feels like on the ground in the US. Are we reading the tea leaves right out here in the outer regions of the empire that indeed Biden is done?
Well, I will tell you, just as a non-political analyst, as an energy analyst, I'll give my personal opinion and my observation as just a citizen and a voter in the United States, which is most of the voting population in the United States is that is not hard in one camp or the other, is very frustrated at the options available. So quite frankly, there's a lot of people that actually didn't even watch the debate. I didn't, because I knew I wasn't going to learn anything. And I found out after, and I was like, okay, I got to at least listen to it. So one of the things that I look at when it comes to how it's going to impact energy, how it's going to impact policy, a lot of these things are going to be a little bit slower moving. One thing that I do find interesting when we get into international markets is a lot of people think that the president says, well, we're going to boost production, we're going to contract production, or we're going to stop LNG. most of these projects, it gets a little bit more complicated in the capitalist structure because if a president says, well, we're going to boost production, it's like you can't do anything. I mean, you
We don't have an oil well in the White House.
Yeah, I mean, unless you change the price, you're not going to be the investments are going to happen or they're not. You can improve the economics, but you can't if you're too far away from the margin, it's not really going to do anything. So when it correlates to energy, one thing that I would say when it comes to politics, and again, not as a political analyst, as an energy analyst, that is very disappointing is measures such as the LNG pause that Biden took on, because that inserts a lot of uncertainty on U.S. trade partnerships for years down the lines. When you look at LNG commitments, these are multi-year, large dollar commitments, and now you've inserted uncertainty. And to piggyback on what
It was just a decision, a court case overnight, a court decision in the U.S. overnight that from a judge, I believe, in Louisiana, who has ruled against the administration on that particular LNG suspension of licenses.
Yeah, and I mean, that move was more for optics in my simple mind. It was more for optics because it wasn't going to impact anything until 2030 or beyond. But when I looked at the optics, I was like, I was confused at what the goal was. Why are you saying that you're not achieving anything? Why are you doing that? It doesn't even sound all that good. So when I look at the energy policies, one last thing that I would say is it's fascinating because people in the energy business in the United States, when people say, well, Trump's going to get in the office, that's going to help improve energy economics for producers. And most people in the energy industry are like, no, prices were terrible while Trump was in office. They've been great while Biden was in office. So if you go by that measure, it's like there's no correlation, or the correlation is
they were over $100 for 4 years when Obama was in office.
Sure.
Russell,
yeah.
I wanted to take the opportunity to, when having you on, is to get the update of your news. Dubai Mercantile confirmed last week the final sort of, I think, ratification approval of the partnership with the Tadawul in Saudi Arabia. If you might just update us, Russell, on exactly the news there and what that means for you and for the Dubai Mercantile Exchange.
Sure. So last week, as you mentioned, the confirmation took place and shares changed hand and dollars were inserted. So Saudi Tadawul Group is now a third owner of the DME. We will change our name to the Gulf Mercantile Exchange, aiming to do that near the end of August, early September. And as we move into that new entity, we'll, of course, continue building our Oman derivatives contract and benchmark for Middle East. But we'll start looking at other products in the region, looking at how do we create pricing for producers rather than at the point of consumption. And if you look at the imports and exports of Saudi, there's many big asset classes there: metals and agricultural products, wheat, gold ingots is one of the biggest import exports of Saudi. I'm not saying we're doing that. I'm just suggesting that there's many things that we can look at from both a high-level commercial strategy, helping these people find price discovery, maybe via auctions or tenders, all the way down to looking at how do we get commodity trading to the man on the street or the person on the street, which today anyone in the GCC tend to be equity traders. They don't tend to have any visibility or access to prices of commodities in the region.
It does feel, in a way, like a sort of an exclamation point on the region emerging as and Dubai in particular, as one of the world's commodity trading hubs. I mean, when you put it in that context, I mean, a lot of factors have contributed sort of to Dubai's arrival. All the national energy companies have set up trading desks. But when you put it in the context of Dubai, obviously you've got a big presence in Singapore for many years. Is it finally emerging, do you think, as a global commodity trading hub? And this is part of that.
Yeah, I really do think so. So another way to look at this is the way I like to look at it in derivative volume. So historically, the energy market, they look at Brent and WTI, right? So those markets are very established. If you look at Oman, the Emir Oman, it's been around for a while, but liquidity's grown a lot in the last few years. If you look at Dubai swaps and then also something like Murban in Abu Dhabi, we've just finished the half year. Those volumes are up this half versus last half, up 62% in total volume as a bucket. If you look at Brent WTI and include even INE into that, which is a big Chinese derivative contract, that's up 8%. So there's a quite significant change in the way people are looking at these markets. And I know that's slightly different to locational activity, but the relevance of these products and the relevance of people needing to diversify their portfolios into more Pacific hedging opportunity is becoming much more relevant now. And I'm seeing that across the board. Many new people coming directly to the market to trade and not just wanting to trade Brent. They want to trade Dubai, Oman, and other things.
Mehmet, last word to you. Our survey results showing that geopolitical risk is the main driver pushing prices above the tight band in the low 80s. One of the things I wanted to get your insights on was we still have the Ceyhan, the Kurdistan to Ceyhan pipeline closed out of North Iraq. What are the outlooks there and for oil flowing between Iraq and Turkey?
Well, for a long time, we've been talking about it because Turkish side says we are ready to open the Kurdish pipeline coming to Ceyhan, and it hasn't happened. And they are losing billions of dollars while there's severe economic problem, not even able to pay the salaries. And then Baghdad-Erbil discussions are going on about the legal status of production sharing agreements for the companies operating in KRG. And Turkey and Baghdad, I think, have developed a different kind of relationship independently of KRG now. And therefore, probably the possibility of Turkish-Iraqi pipeline originating from Kirkuk to coming to Ceyhan will be open before the KRG pipeline. It's going to carry around 350,000 barrels of oil, and it was practically almost nil, except some put into the Kurdish pipeline in the past, about 35 to 50,000 barrels. So now negotiations are going on between Erbil and Baghdad. Baghdad would like to put the maximum pressure on Erbil so that they can have their will on how the production sharing agreements will be restructured in a way that will fit also Iraqi objectives. And then Turkey has its own upper geopolitical objectives with Iraq, building this development path coming all the way from Basra to Turkey. And then, as I said before, Baghdad is playing host to Turkish Syrian leaders in the coming weeks to start the normalization. So for Turkey, I think it's more important to have better relations with Baghdad, but without neglecting Erbil somehow as well, because within the Kurdish groups as well, as we know, there are disputes, Talabani and Barzani clans in KRG. So it's a very, very complicated geopolitical picture there. But sooner or later, I'm sure that the Kurdish oil will start moving because it's about 450,000 barrels per day. It's not a small, insignificant amount.
Well, it's a point to wrap up and to note that with the recent report that shows that Iraq is already overproducing its OPEC quota, so more oil coming out of Kurdistan, how that fits into the Iraqi quota now is going to be interesting. But we're going to have to wrap it up there because we've come and exceeded our time. We've got Brent crude oil trading at 86.86. Will it break above 87 and close there again and make that continued march up onto the high, of 90 as we saw with the geopolitical risk of the first quarter? We'll have to wait and see. Mehmet Ogucu, thank you so much from Turkey. Brian Pieri from Colorado and Russell Robertson from the Dubai Mercantile Exchange. Thank you so much for your insights this morning and look forward to catching up with you all again soon. Take care. Bye-bye.
Thank you.
Bye-bye.
Are we done?